Hello and welcome to the Mainstream Mortgages Podcast. I'm Derek Van Dell, your host today. I'm joined with, again, my coworkers at Mainstream Mortgages, Peter Paley and Colton Boudreau. Today is January 15th, and we're going to be talking about alternative and private lending. So, for anybody who may not have heard of alternative or private lending, or maybe they've heard of it but just haven't really delved into what it is. Peter, can you tell us what is alternative lending and what is private lending?
Sure. So alternative lending is also referred to as B lending in our industry. And what it is, it's for people who have bruised or damaged credit, have good equity, and it's really been transforming into like larger type mortgages, like where property values are 1.5 million and above. And even for self-employed people who write their income down to a very low level and can't qualify at the bank, the alternative lending space is going to provide a lot of different programs to help those people qualify for mortgages.
Okay, and how do the interest rates, fees, and terms differ between banks, alternative lenders, and private lenders, Colton, if you want to dig into that one?
Yeah, so the rates are going to be a little bit different when it comes to alternative lenders. I'll start there. Typically speaking, like right now, they're about 1% higher than your standard banks, your A lenders, we'll call them. Um, and there's different factors that vary into the rates and the different alternative lenders, but I won't really, dive into that too much. But there's typically a fee involved, and it's normally 1% of the mortgage amount that you will have to pay out of pocket. That's for traditional, or sorry, alternative lenders, while as in private, the interest rates can be about 14%, but you're probably paying a bigger fee to the broker, and there could be a lender fee as well.
So you just said that a private lending mortgage rate could be as high as 14%. That is kind of like sticker shock, I think, to most people. So, Peter, like who is a private lending mortgage for, and who is it not for?
So private lending's been typically used as a really short-term bandage solution. If you are going into that lender, there's either a really big credit concern, you had approval at a prime lender, but maybe bought a new car or ruined it somehow. That is possible. Or maybe you're someone who's facing foreclosure and needs a little bit of time to get the lender off your back and have the ability to be able to sell your home because nobody really wants to go through the fees involved with the foreclosure process. And while Colton mentioned that 14% number, I think for more reasonable private files, you're going to be more in the range of 9 to 14%. That 14% really applies more to second mortgages than first mortgages, but they can definitely get up that high. It really is going to go by a case by case basis and what the actual situation is.
Okay, so you mentioned it's more for like the higher rate is more geared towards a second mortgage instead of a first mortgage. Can you explain that a little bit? What do you mean by second mortgage?
So if maybe let's say someone's having some financial difficulty, the credit cards are too high, they can't qualify for a refinance at their bank or credit union. They can look at a private mortgage to clean up some debt, bring everything into a more manageable solution, keep it for a few months, and then hopefully at that point be able to pay either some of that extra debt off or refinance at a later time. Like these alternative and private lending solutions, they're really short-term solutions. And for alternative lending, we're looking like maybe 1 to 3 years. And private lender, we're hoping to be a year or less.
Okay, so when just to clarify, when you say second mortgage, you're referring to a second mortgage on the same property. Like you got two
Yeah.
different mortgages, one with a bank, for example, that's your first mortgage, and then a second mortgage with a private lender. Okay. So, okay, so why would somebody oh sorry, we talked about private lending mortgages and who that's meant for. What about Colton? What about the alternative lending mortgages? Who would that be for?
Yeah, so Peter kind of mentioned it already off the top. One, if you're self-employed and you write your income down, we're able to basically look at your bank statements over a full year and extrapolate that number, which obviously would help self-employed people qualify for much more of a purchase price. Well, if you do own a home, it's meant for bruise credit essentially. So if you had to go into a consumer proposal, B lenders look at paying that out. They allow that. If you have credit woes, like Peter mentioned, or a lower credit score, B lenders are typically more favorable when it comes to lending to said clients.
Okay, and Peter, you mentioned that the alternative and the private lenders are more of a short-term solution, right? Um, would you say that is it possible that a mortgage broker might be pushing a borrower into a private mortgage just to, make a higher commission or so that they can charge a fee off you and make more money off of you? Is that something that happens?
Well, to be honest with you, like alternative lending, like the fee of 1%, half usually goes to the lender and half goes to the broker. So it's not really profitable for a broker to be in that alternative lending space. It's solution-based lending for clients to help them get back on their feet to move over. Private lending is maybe a little bit different because brokers can set their own fees. And while there is legislation to help protect from over gouging. There's definitely been stories over my career as a broker where people have been overcharging for private lending. However, it's really important to also understand that in that private lending space, there is a lot of risk usually towards the lender, and the lender wants to make sure they're compensated, and the broker also wants to make sure they're compensated for their time as well. And as many of our private lenders like to say, like if you had 5% down to buy a house and you qualified through the bank, the mortgage insurer is going to charge you 4 whole% as a premium for that privilege. So it kind of puts private lending maybe a little bit more into a perspective that if you're paying 1 to 3% of the mortgage amount, that you're going to be okay. And typically, like again, like this is a band-aid solution usually to get you out of some contractual problem or to help you prevent from foreclosure.
That's a good segue into my next question for Colton. It's what is the strategy, I guess? What should people be using private lending for? What are the not only private lending, but also alternative lending? What can they do strategically to improve their financial position?
Yeah, so like Peter mentioned, they're band-aid solutions, right? So whether we're paying out debt or consumer proposals, anything like that, it's basically allowing these individuals to, get their footing back, right? And they're using their home equity as a resource here to help prevent them from whether it's going into foreclosure or just down that slippery slope of losing the house, whatever it might be. So it allows them to reset their footing, even if it's for the year, like Peter mentioned, or the 3 years. It allows them to rebuild their credit, which we help them do, because most lenders on the more traditional side need 2 years of reestablished credit. So we work with them through that. We build it back up, and then our goal is to get them back, whether it is from private to the alternative back to the A side or traditional side. It's a process, right? And we help our clients go through this process in order to get them back, get to them living the life that they used to live, right?
And how long would that process typically take, would you say?
So it really depends on their financial situation and the outlook, but I would say I would just give a vague answer of 2 years. Like I said, credit needs to take 2 years to be rebuilt. So if it's worse, their credit is worse, obviously it'll take a little longer. If it's better, then you could look at an alternative lender for a year, right? And then get them back to a traditional lender after we fixed whatever we needed to fix.
Right. And can you typically, like if somebody's in a private mortgage, can they if they fix their financial situation within like 2 years, like you say, can they go straight from a private mortgage to like a bank traditional mortgage?
Yeah, I mean they can. I wouldn't say never, but typically speaking, you do that gradual of private to alternative to traditional. But yes, if they do completely clear up everything, the credit scores are good, they've reestablished for 2 years, their incomes are back to where they need to be, and everything just kind of fits the box of that traditional lending, then yeah, they could ultimately get back up there.
That's awesome. So there's hope.
Always, there's always
Peter,
hope.
yeah, Peter, if if somebody's mortgage broker is trying to tell them like, hey, you need a private, buddy, you won't qualify for alternative or traditional, you need a private mortgage. What are some of the things that a borrower should look out for, or maybe questions they should ask if they find themselves in that situation?
I think the first question to ask is, why do I need this? Like, why is my credit score bad? Is my income too low? Is like it's really hard to like just give you some really straightforward answers because every file is going to be a little bit different on this alternative lending space. But if you're like typically the main reason would be I cannot get you qualified at the bank or the credit union. And for whatever reason that is, like there's, as we all know, there's like probably 20 good reasons why you can't do that, like from non-guaranteed employment hours, bruised credit, self-employed income being written down too low, property tax arrears, income tax arrears. They're, those are the top five that I would say that would put someone into a private or alternative lending space. But there's like another 15, like I mentioned. Like for example, can I give a real life example here? We just
Sure.
helped clients this year. They moved from another province to be closer to their grandchildren. They sold their home. They had a lot of money that they could have just paid cash for their house that they're in, but they didn't want to do that because that's also their retirement nest egg. So they had a plan to move to a Manitoba community and get some employment. So we used a private lender to do that. So they went into a private mortgage. They have their own home. It's titled in their own name. They went and got their jobs. And now they've been living in this property for 5 months. And now we've qualified them at at a traditional lender who was happy to take their business after they had employment and income and meet all the traditional mortgage lending criteria. So this was a excellent example of where a private lender came in, and for these people, instead of them trying to go find a place to rent and live and then move, then get established, then um, try to buy a property and maybe have to sublease their lease and then move again. Like it was just a way more cost efficient option, even though they're in a private mortgage with a 10% interest rate. It was only 5 months. And the amount of their payments, as it worked out, was just about the same amount they'd be paying for rent in the community that they chose to live in. So it was a really good solution.
That's a really great story because I think a lot of people think about alternative and private lending in a very negative light, like it's some sort of dark lending area where it's not always the case. So it's nice. Everybody likes a happy ending. So I think that's a good place to kind of wrap it up, unless you guys have anything else you want to add before we do.
Believe it or not, I'm good this week.
Yeah,
Wow.
I'm good too.
All right. Well, thanks again, guys, for chatting with me today. And if anybody out there listening needs help with alternative or private lending, you can reach out to us at Mainstream Mortgages using our email at greatrates@mainstreammortgages.com or our phone number 431-482-2187. Thank you so much, and we'll see you all on the next one.